Understanding listing requirements, a comprehensive guide. Listing requirements are essential criteria that companies must meet to be able to list their securities on organized stock exchanges, such as the New York Stock Exchange, NYSE, the Nasdaq, and other international exchanges. These regulations are put in place to ensure only high-quality securities are traded, and they serve to establish a level of trust and transparency in the financial markets. What are listing requirements? A stock exchange establishes listing requirements to maintain its reputation and ensure only viable companies can participate. These requirements serve as a way to protect investors and the integrity of the market by ensuring that only companies that are financially sound and have the potential for future growth can have their shares traded. Key components of listing requirements. 1. Initial requirements. Companies seeking to list their shares must fulfill certain minimum criteria before they can begin trading. This includes factors such as market capitalization, number of shares outstanding, and overall financial health of the company. 2. Ongoing requirements. Once listed, firms must comply with ongoing financial reporting and corporate governance standards to remain on the exchange. Failure to meet these criteria can lead to delisting, which can damage a company's reputation and market visibility. 3. Fees. Companies are required to pay both initial and annual listing fees that can vary significantly depending on the exchange. These fees are often tiered and can increase with the number of shares traded. 4. Liquidity. Exchanges require firms to have a minimum number of publicly traded shares available to ensure adequate market liquidity. This is critical for maintaining investor interest and ensuring that shares can be bought and sold without significant price fluctuations. Listing requirements across different exchanges. New York Stock Exchange, NYSE. Minimum of 1.1 million publicly traded shares. Minimum combined market capitalization of $40 million, $100 million for worldwide trading. Minimum stock price of $4 per share. Nasdaq. Minimum of 1.25 million publicly traded shares. Minimum combined market capitalization of $45 million. Similar minimum stock price requirement of $4 per share. Dow Jones Industrial Average, DJIA. The DJIA has relatively fewer rules regarding inclusion, focusing on non-transportation and non-utility companies. Listing on either Nasdaq or NYSE. Accounting for a significant portion of U.S. economic activity. Presence among major companies within the industrial sector. Tiers of Nasdaq listings. The Nasdaq categorizes listings into 3 tiers, each with distinct requirements. Nasdaq Global Select Market, highest tier requiring rigorous financial standards. Nasdaq Global Market, for companies that meet slightly less stringent criteria. Nasdaq Capital Market, designed for smaller companies with growth potential. Consequences of failing to meet listing requirements. Delisting. Delisting refers to the removal of a company's stock from trading on a stock exchange. Conditions that can lead to delisting include failure to pay annual fees, falling below minimum equity levels, share prices dropping below the minimum threshold set by the exchange. While delisting does not incur a legal penalty, it can severely impact a company's visibility, credibility, and ability to raise capital, pushing investors to trade its shares over the counter, OTC. The importance of listing requirements. The enforcement of listing requirements aligns with several overarching goals. Investor protection, ensuring that companies are financially sound mitigates the risk for investors. Market integrity, high standards of entry help maintain the reputation of exchanges, enhancing overall market trust. Regulatory compliance, it encourages ongoing adherence to fair trading practices and transparency in financial reporting. Conclusion. Listing requirements play a critical role in the structure of financial markets, akin to gatekeepers that allow only qualified firms to participate in organized trading. Understanding these criteria is essential for prospective public companies and investors alike, as they significantly influence investment attractiveness and market dynamics. By ensuring only high-quality securities are traded, these requirements foster a robust environment for capital formation and economic growth.